And the way we're able to do that is through an engineering-based study where we come in, identify different components of the building, or just as the name implies, we segregate the different components of your building, such as carpet, countertops, cabinets, appliances, ceiling fans, the parking lot, curbs, gutters, asphalt, retaining walls, all those things I mentioned. The IRS says specifically in their tax code should be depreciated over a much shorter life than 27 and a half years. Usually those lives are either...
Welcome back to the Real Estate Law Podcast. Thank you so much for once again listening to us. Jason Muth here with straightforward short-term rentals and pride-of-way stays. Rory Gill, our resident real estate attorney, who's also tech support today. Rory, you hooked me up with a ring light, which I don't use enough of when we're recording these, but I think I look a little bit more even than having shadows on my face, right?
Right. Pretty soon we can have a whole setup for you with 4 different ring lights and, a backup microphone and everything. You can have a full studio up in the living room.
Yeah, we'll have to do it behind the scenes of this podcast because there's a lot of people that are doing podcasting a lot more elaborately than we are. And I do want to get one of those setups. We haven't quite invested in it yet, but talking about investing, now we have the money to do it because of gentlemen like this one, Erik Oliver, who is with Cost Segregation Authority. Erik, we have an interesting history that we only learned about just a few weeks ago. First of all, welcome to the podcast.
Oh, thank you. I'm glad to be here. Thanks for having me.
Erik, what's your title at Cost Segregation Authority? You're a VP of something, right?
Vice President of Channel Partnerships.
Okay, Vice President of Channel Partnerships. And first of all, you are now the authority for cost segregation, no pun intended, with the Real Estate Law Podcast, okay? Because you're the first one we've had on really doing a deep dive on this. And the reason we want to have someone from your company on is because we are customers of Cost Segregation Authority. And it's funny how we came to you because... here's the full circle moment. So I was at BPCON 2022 in San Diego. Erik, you claim that you were there as well, right?
Yes.
Yes.
I was there.
Erik was there. He was on stage in front of a packed room of people talking about tax strategies. And one thing I came home with like 2 or 3 big takeaways from that conference. One was a bunch of people who I met, specific people who I still talk to this day. The other one was I came home and I said, Rory, we need to do a cost segregation authority. We need to do a cost segregation study on some of our properties. I listened to this panel. I think this is what all the real estate investors do. At the time, we didn't realize that this is actually kind of a common thing. So you educated us, Erik. And I said, there was a guy on stage talking, and I think we should call that company and do that. So we made one phone call, and it was to Cost Segregation Authority. This is not a paid endorsement. And we said, your guy was on stage. We liked what he said. Can you do it for us? So, and now here we are. Your people reached out to us to come on the podcast, and I'm like, wait a second, I think I know that guy.
Yes, full circle. Yes, what a small world, right?
Very, very, very full circle. So, Erik, first of all, why don't you tell us a little bit about yourself and how you got started with Cost Segregation Authority, and then we really want to talk about why this is something that real estate investors should be doing if they're not pursuing it. In our world, once I transitioned into this away from my W-2 world and realized that the short-term rentals that we had were, we're just sitting there without us taking all of this additional bonus depreciation and whatnot. It was a big opportunity for us, to not just free up some capital, but reinvest and redeploy it back into real estate investments. And, it just became something that was completely eye-opening to us. And I think the average person doesn't understand it. So we will get into that in just a second. But, Erik, tell us a little bit about yourself first and tell us about Cost Segregation Authority.
Yeah. So myself, born and raised in Salt Lake City, Utah, went to school, got my degree in accounting. Never really pursued being a CPA. I was just trying to get out of college as quickly as I could. Math always came easy, so it was either finance or accounting. Hated writing papers, so I'm like, okay, I'm going to do a math degree. Got my degree in accounting, went into sales actually. A couple sales jobs took me to Richmond, Virginia for a number of years, about 10 years, and then Long Island, New York for about 6 years. And then parents were getting older, wanted to move back. I had a family at that point, wanted to move back to Salt Lake. So I'm back in Salt Lake now. When I moved back to Salt Lake, I was looking for jobs and just came across Cost Seg Authority. At the time, honestly, I didn't know what cost segregation was. I knew it had to do with accounting. And so as I started looking into it, I had a couple rental properties at the time, and I thought, wow, this is pretty powerful stuff. Met with the guys here, great company. Company's been around about 20 years now. Done over 2,500 studies, work with investors, tax preparers all over the country, really trying to first educate, because a lot of people still don't know about cost segregation or the power of cost segregation. So just educating people, trying to help them save money where we can. So that's a little bit about us in the company.
Yeah. I'm in a short-term rental mastermind group, and I've talked about cost segregation in that group in the past, I don't know, year and a half I've been involved. And a lot of people also don't know what that is. These are people that own properties. These are people that are short-term rental investors and co-hosts. This is not a common conversation point for anybody that's not in this space. Why do you think this is such a deep down topic that the average person doesn't know about? And how can we improve that and teach more people that this is one of the great strategies that you could use if you're investing in real estate?
Yeah, no, that's a great question. So I think part of the reason is a lot of us, when you get into real estate, I had to learn the hard way, unfortunately, but when you get into real estate, you really have to build a team around you of people who specialize in different things. I'm not a great marketing person. I'm not a great property manager, for example. And so you've got to build your team. And I think a lot of people, when they're building that team, they're like, okay, I need a CPA or a tax preparer. And they build that and they think, okay, well, my tax preparer is going to handle everything accounting. I look at our CPAs kind of as your general practitioner. They know a little bit about a whole wide array of subjects. The tax code is thousands and thousands of pages, and it changes every year. And so a lot of tax preparers, unless you're working with somebody who specializes in real estate, they just don't have the bandwidth. It's not because they're negligent. It's not because they're incompetent. They just simply don't have the bandwidth to be able to dive deep into all these different categories. And so that's where Cost Segregation Authority fits in, is we want to partner with the tax preparers. We're kind of like the heart surgeon, and they're the general practitioner, is how I look at it. You wouldn't go to your general practitioner if you had to have open heart surgery, because that's not something they specialize in. They know a little bit about a whole wide array of subjects, but once you need a specialist, they'll outsource that and they'll go to the specialist. So that's kind of how we fit into the whole mold. But I think that's why a lot of people just aren't aware of it. If you're just relying on your tax preparer, you think I've met with a lot of people who say, oh, my tax preparer is doing cost segregation. And then we look at the return, and sure enough, they're not. They just assume that they are because they assume that they've got that bandwidth and the knowledge to be able to do it. Mm-hmm. And so I think that's a big problem. And then I think education is the other thing. There's been some recent changes to the law that make cost segregation a lot more favorable to a lot wider array of investors. It used to just be, 5-7 years ago, it was for your large institutionalized investors, people who were buying hotels, casinos, etc. But with some of the changes to the tax law, cost segregation makes absolute sense now on everything from, a single family rental all the way up to a ski resort. And so just getting that knowledge out, not only to the investors, but also to the tax preparers as well.
Mm-hmm. Well, we're staring at our tax preparer right here, and that's Mr. Attorney Gill in front of his background. And Rory, you actually didn't know about this when we were doing our taxes before they got super complicated, right?
Right. So, I mean, to your point that there are a lot of professionals out there who know a little bit about everything. That's certainly true. And everybody who does taxes in the real estate space knows about depreciation, about maybe segregating the land value from the building value. But what you're talking about here is much, much deeper than that. And you're right. Part of this may have been off people's radars because before, I'm sure we'll get into it, but bonus depreciation and a few other factors, this really only made sense for certain types of projects, certain types of investors. But now it's opened up to a wide array of people. So let's talk about that a little bit. What is cost segregation, and fundamentally, what are you doing? And then we'll take that and we'll apply it to your taxes.
Sure. So cost segregation really is just accelerated depreciation. So one of the benefits on your real estate, I should say. So one of the benefits of owning real estate is the ability to take depreciation. So depreciation normally gets separated over 27 and a half years for residential units or 39 years for commercial units. Commercial buildings. So let's take a residential. Let's say I buy a single family home, just to make the math easy, for $275,000. I take that, divide it by 27 and a half years. Essentially, I'm getting a $10,000 write-off every year for the next 27 and a half years. Now, I've oversimplified that a little bit because you have to always take out land value, but just to make the numbers easy, basically you're getting a $10,000 write-off every year, which is great. That's why a lot of us get into real estate, is for some of these deductions. But I may not own my building for 27 and a half years. I want my deductions at a much faster rate than spreading them out over 27 and a half years. And the way we're able to do that is through an engineering-based study where we come in, identify different components of the building, or just as the name implies, we segregate the different components of your building, such as carpet, countertops, cabinets, appliances, ceiling fans, the parking lot, curbs, gutters, asphalt, retaining walls, all those things I mentioned. The IRS says specifically in their tax code should be depreciated over a much shorter life than 27 and a half years. Usually those lives are either 5, 7, or 15 years. Well, by moving a chunk of that purchase price into a 5-year category, you now get to depreciate that over 5 years versus 27 and a half. So you're front loading your depreciation. Number of reasons why you want to do that. There's cash flow, there's inflation. Inflation's a hot topic right now. I want my money today versus 27 and a half years from now, so I can, pay down my debt or reinvest it in new properties. And so a lot of us want to take as much deduction as we can today. And that's how we're able to do it, is by segregating the cost. And if you think about it, when you get that closing statement from your transaction, you close on a property, you get a closing statement, you hand that to your tax preparer. All they see is that you bought a single family home for $275,000. They have no idea if there's even carpet in the building, let alone what the value of that carpet is when you bought it. And so that's where a cost segregation study would come into play.
Yeah. So I appreciate that bucket. So you're taking everything, you're slicing it up into bits, because each bit might have its own faster timetable for depreciation. So that's great. So if you have landscape improvements, that's a component of it. That's going to be 15 years instead of the 39 years for commercial property, appliances, 5 years, et cetera. So you're accelerating it. And again, I think that makes sense for maybe some larger projects where after you invest in getting the cost segregation study done, you're pulling money out in a much faster basis. But the other thing that this really works well with is the idea of bonus depreciation. And that is kind of, in my opinion, and correct me if you disagree, this is what makes it more applicable to regular investors who are investing in a short-term rental, a single family, a two-family, and making this opportunity practical for them too.
No, you hit it on the head. So bonus depreciation basically puts cost segregation on steroids. And so bonus depreciation's been around for a number of years. The IRS uses the bonus depreciation to basically stimulate the economy. So if the economy's not doing well, they'll increase the bonus percentage. If the economy's doing well, they'll decrease the bonus percentage. So back at the end of 2017, with the Tax Cuts and Jobs Act, Donald Trump was our president. Donald Trump owned real estate. And when he revised the tax code, it was very favorable to real estate investors. Prior to the Tax Cuts and Jobs Act, bonus depreciation was at 50%. And it applied to assets that were brand new that had a useful life of 20 years or less. So to put that in context, you go buy yourself $1 million bulldozer and it was 50% bonus, you would get to take $500,000 or 50% of the million, depreciate all of that in the first year. So you get a $500,000 write-off. The other $500,000 would spread out over the useful life of that asset. But remember, it had to be 20 years or less, had to be brand new equipment. Fast forward to the end of 2017 with the Tax Cuts and Jobs Act, two things changed. One is it went from 50% bonus to 100% bonus. So that was the first major change. So any assets placed into service between 9/27 of 17 and 12/31 of 2022 were eligible for that 100% bonus. The second thing, which I think was even more impactful, was they added 5 words to the tax code. Remember, it used to have to be brand new property. Now they added new to you, the taxpayer. I think that's actually 6 words. New to you, the taxpayer. 6 words. So I think it's actually 6 words. They added those 6 words to the tax code, but that changed the game for everybody, because now I don't have to go buy a new bulldozer. I can buy a used bulldozer. It's new to me, the taxpayer, and now I'm eligible for 100% bonus. So in that example, I go buy a used bulldozer for $1 million. I get 100% bonus and I get to write off 100% of that, or the full million in the first year. So enough about bulldozers. Let's talk about real estate. How does this apply to real estate? So a lot of tax preparers, believe it or not, when I meet with them, they'll say, well, bonus depreciation doesn't apply to real estate because bonus can only be utilized on an asset that has a useful life of 20 years or less. Residential units are 27 and a half, commercial units are 39, so it doesn't apply. Well, where it applies is when you do a cost seg study, we come in and we identify 5, 7, and 15-year assets, which is usually makes up about 30% of the building's value or the purchase price minus the land. So we'll usually segregate somewhere around 30%. And all of a sudden that 5, 7, and 15-year assets are all eligible for 100% bonus depreciation, which means you're essentially writing off 30% of the building in the first year versus taking 1/27th or 1/39th of that building. And so bonus depreciation, 7 years ago, like you said, cost segregation didn't make sense on a small single family home because, yeah, a $200,000 home, we're going to segregate around 30% of that. But then remember, your 5-year assets get spread out over 5 years. Your 7-year assets get spread out over 7, your 15 over 15. But now with bonus depreciation, we can take a huge chunk of that all in year one, which definitely, on a $200,000 single family home, if we segregate 30% of that, that's $60,000 worth of depreciation. And if you can take 100% of that in year one, and you're in a 35% tax bracket, that's a $20,000 tax savings in year one on a $200,000 home. So it definitely has made it more applicable to some of the smaller investors versus the large institutional investors.
Yeah. No, for these smaller investors, when you take this major deduction in 1 year against your passive income, I can see lots of situations where this deduction will exceed the passive income in the first place. What should people do? What happens in a situation where somebody's deduction just far exceeds their passive income in the first place? What benefit is this to them to have done the cost segregation in the first place?
Sure. So the great news is the deduction never expires. So it just carries forward indefinitely. So if I'm a passive investor, I've got 50,000 of passive income and a cost segregation study's done and I get $100,000 of deduction, I'll wipe out that $50,000 of income. The remaining 50,000 carries forward and will wipe out the first 50,000 of passive income the following year. So you never lose the deduction, number one. Number two, if you ever have a capital gains event, so if you ever sell an asset, it'll unlock if your capital gain will unlock that remaining deduction up to the value of the capital gain. So if I have a capital gain event and it's $100,000, it'll unlock $100,000 of that deduction that I've got on the books if I've got it there. And so a lot of people will do cost segregations, even if they're passive investors, in years that they sell an asset so that they can not pay the large capital gain bill and use the deductions from the cost seg to offset that capital gain bill. So there's a couple ways around it. And then if you have the golden ticket is kind of being what we call a real estate professional. So if you or your spouse can qualify as real estate professional status for tax purposes, now all of your deductions from your cost seg become active, become active. All of your income is active and they offset each other, even though it's real estate income. And so that's kind of the golden ticket if you can meet that qualification, which for most people is about 750 hours a year doing real estate. It's about 14 hours a week. And that's the easier test. The harder test is you have to spend 51% of your working time. Mm-hmm. And so if you can meet that qualification, it's a home run, but there's still opportunities for those who don't meet that qualification.
Yep. That was that golden ticket is something that I wish we planned for this in advance and had the great foresight and created this. But at the time, for the last few years, I primarily worked as a real estate broker, which granted myself that status. Now, within the past 6 months, I've kind of shifted and gone to do more work as a real estate attorney, which ironically doesn't qualify as a real estate professional. Right. But Jason's taken over now and works as a full-time real estate investor and real estate property manager. So we're getting that status, through him. So we kind of backed into this kind of golden recipe right there.
Right.
So, I'm thinking we have kind of this enormous deduction that we get to take. We've taken it a couple times in a row against future income for the year. Let me get into a couple specific questions with the cost segregation, and then we can broaden it back out again.
Sure.
You're talking about people who are doing this in anticipation of a capital gains event. Has this had a effect on the 1031 market? Are there less 1031s out there as a result because people may not need to go through the 1031 process if they can use cost segregation on a different asset to counter it?
Yeah, I think the term I've heard is cost segregation is the poor man's 1031 exchange, I think, or as what I've heard. But yes, cost segregation can be used as an alternative to a 1031 exchange. We've got a lot of clients where their 1031 exchange has fallen through for one reason or another. They've stuck with a large capital gain, and they're able to do cost segregation on some of their other assets to offset that capital gain. So I do think that bonus depreciation has played into that. Maybe fewer people are doing 1031 exchanges, but keep in mind that bonus depreciation is set to phase out. So the 100% bonus was 9/27 of 17 through 12/31 of 2022. In 2023, that went from 100% to 80%. So any assets placed into service in 2023 are 80%. Anything bought this year is 60%. It goes to 40% the following year until 2027 when it's down to zero. Now, the caveat there is a bill in Congress right now. It's actually passed the House. It's sitting in the Senate. It's got bipartisan support, which is hopeful, but they're planning on extending the 100% bonus through 2025. So people were kind of waiting tight on these 2023 tax returns because you don't want to file it with 80% bonus, and then they pass a law and it's now 100%. So a lot of people are extending for that reason. We were hoping that Congress would get their act together and have this bill passed by January 29th, which was the start of the tax filing season. But it's an election year. There's some debates on whether anything's going to get passed this year because of the election year. So we're keeping our fingers crossed that they do extend the 100% bonus. But if bonus goes down, then the 1031 again is a great alternative. They can work hand in hand together.
You gotta get your lobbyists in Congress. Get them going, Eric. Get this bonus going on again.
I know.
So let's say it does phase out though, right? Like, so you guys existed before bonus depreciation was a thing. So are there still benefits to doing cost segregation study even without this bonus depreciation?
There absolutely is, because remember, you're taking assets that normally get depreciated over 27 and a half or 39, and you're moving it to 5, 7, or 15. What I think it does when bonus starts to get down in the 20% bonus or 0% bonus, I think it will squeeze out some of the smaller investors. It will no longer make sense to do a cost seg study on a $250,000 home. It might have to be a $500,000 home, but quite frankly, with the prices of real estate now, it's hard to find $250,000 homes, depending on your market. There are some markets where those are still available, but so I do think that will change. When bonus depreciation wasn't at the levels that it is now, we didn't do quite as many smaller properties, but I think there's some solutions out there. There's software that's coming into the market that does these cost segregation studies. It's not really tried and true through an IRS audit yet. And it's kind of based on a modeling where it's really ultra conservative, but there'll be solutions, I believe, if and when bonus phases out completely for some of the smaller investors.
Rory, you had another question. I just had to jump.
Yeah, I have a few. I mean, even in the era of bonus depreciation, are there situations where it doesn't make sense for an investor to undergo a cost segregation study?
Yeah, that's a great question. So one is if you're investing through an IRA, you're not paying taxes, and so you don't need any deductions. You don't get to take depreciation. So that's the first thing. We get calls where people take retirement money, put it in an IRA, buy some property, want to do cost seg, and obviously because you don't get to take depreciation, you can't accelerate that depreciation. So that's the first thing. Second thing would be we tell people all the time, use it to manage your tax bracket. So if I buy a property this year and I invest a lot of money in fixing it up, I'm going to have a lot of write-offs already. If those write-offs are enough to get me into that lower tax bracket, I may not want to utilize my cost seg study this year. I want to utilize it next year when I get my payout from my company and I'm in a higher tax bracket. Now I'm being taxed at 37% versus 10%. So the nice thing about cost segregation is you don't have to use it in the year you buy the property. The IRS allows you to kind of just keep it in your back pocket, take your standard deduction for 2 or 3 years, and then that year where you either A, have a large capital gain event, or B, have a lot of income, that's the year you pull out that card and say, hey, I'm going to do my cost seg study this year. The IRS allows you to do that without having to amend your tax return. So there is that form. I think we were talking a little bit about the program, or before the program, the 3115. It's called the change in accounting method. It's a form that we provide with the study that just tells the IRS, hey, I've been taking my standard deduction. I'm now going to accelerate my depreciation. Here's the difference in those numbers. And you can do it without amending any returns. It's kind of interesting. We're actually checking a box on there where we're saying that we went from an impermissible method of depreciation to a permissible method. So you're telling the IRS, hey, I was doing it wrong. I was depreciating my carpet over 39 years. My mistake. I should have done it over 5 years. But by the way, that gives me this huge write-off. Now, the IRS isn't going to come tell you you're doing it wrong because that's just money in their pocket, right? But in theory, you're actually doing it wrong. If you're not cost segregating every property, according to the law, you're doing it wrong. You're depreciating your carpet over 39 years, not 5 years. So to answer your question, yes, you can hold those in your pocket. You don't want to do cost segregation if you don't have a lot of income. It doesn't make sense to pay us to do these studies if you don't have any income and you're just going to push those deductions forward. Just wait a year or two to pay us to do the study and use the deductions when you can. But those are kind of the two instances of one, if you don't have enough deduction, and two, if you're investing in an IRA.
I remember coming back from Bigger Pockets in October, and my job had ended in July, and I switched over to the short-term rental world full-time shortly thereafter. Got educated, joined a mastermind, went to conferences, started meeting more people, and came back armed with all this great information. And I remember I referee in a flag football league. I've been connected to the league for like 15 years down in Boston. I remember telling people about all this stuff, and like they're looking at me like I'm insane. Like they have no idea what I'm talking about. And I'm like super excited by all of this tax saving that I'm finding and all these ways that I'm learning that real estate investors, kind of behave like we were always doing it as weekend warriors. Like, our first investment property we purchased in 2016, so like we're not novices in the real estate investing world, but we just kind of missed this message. Right. And then you literally hit us over the head with it at that session. And then here I'm telling people, I'm like, it feels like I'm stealing. Like, I don't know, maybe they're going to send me to jail if we do this. But like, you're describing the fact that, we're amending stuff by saying, hey, IRS, we did it wrong. All right. We're now going to do it the way that you want to do it. And by the way, it's more favorable to us. It's just a very strange way to think about this. I will say, when you do that amended return, as I mentioned to you, Eric, a couple of weeks ago, the IRS is not that happy to send that money back to you, and they will retain it for a long period of time, as they've done with our amended return.
Yes, they don't have a problem. They'll make you pay, they'll charge you interest, but when they hold on to your money, it's not the same rules.
I mean, where are we right now, Rory? We're well over a year after filing an amended return for one of our past tax years.
We're pushing 14 months waiting for an amended return.
That's
14
crazy.
months.
Yeah.
Yes. And this is not an insignificant amount of money. So we would like that back, IRS. If you're listening, take a look under MUTH, MUTH, and GILL, GILL. Everything else is all on the up and up, and you can go find our return and just process it, please. Why don't we talk about the process really quickly, of a cost segregation? I could actually speak to it a bit from my perspective as a customer, and then you could fill in the gaps as to,
Sure.
what I don't know. If you don't mind, I'd be happy, like after, calling you and getting you all set up. My understanding is you guys used to go out and you'd fly into these markets and you would with a clipboard, you'd figure out the blinds are here, the arborvitaes are here, the retaining wall is here, the carpeting's here, and this and that. COVID hit, and then it was permitted to do this via like Zoom or via FaceTime. Is that do I have any truth to that?
No, you're exactly right. So we used to go out, we had a team of guys that would travel the country. They'd go out and do these cost segregations. We kind of group projects together in different parts of the country. COVID hit. One of the few things that was positive that came out of COVID was we were able to start doing these site visits virtually. So travel restrictions, we weren't able to get to places. And so we had to learn how to do these virtually. So now we use, like you said, a video conferencing app similar to Zoom, where we can actually go, you've got your smart device, we're going to ask the questions, show us the plumbing, show us the electrical panel, show us the flooring in the kitchen. There's certain things we need to see in order to be able to conduct these studies. Once we see those, we'll put the numbers together. Our deliverable back to you is about a 40 to 50 page report. Honestly, your tax preparer is going to skip the first 49 pages. Rory, I'm sure you didn't read the first 49 pages. You probably skipped to the depreciation schedule in the back. That's where we have our revised depreciation schedule, where it has everything line itemed. And then that's uploaded in the tax software, and that's how the deduction is realized.
Erik, you'd be surprised. We read or skimmed the entire report because it was fascinating to go through, right? And before we even got to that point of the walkthrough, I should say that, when we reached out to your company, you sent back kind of a teaser, like a 2-page letter or an email or something saying, like, given what you've described about the property and what we know about it, what we could see on Zillow and what we know about the sale price and everything, here's kind of what we're thinking ballpark wise as to what we could be putting into these different 5, 7, 15-year categories and how much depreciation you could pull forward. Clearly that's a way of saying, hey, and I can't use that, right? But I can get you, I can then pay you to do the study. So we enter into contract. We set up a date. I show up at the property. We somehow have the call, whatever it is. I'm actually physically walking through with my phone, showing everybody what, the questions that your team members asking, literally showing the blinds, showing this rock, showing the countertop, that's what we're doing. You're recording the whole thing, I believe, so you can refer back to it to make your report. And, the report is that really long document that, by the way, and I learned this along the process, we don't file that. So like, if you do this, you don't file it with the IRS, you have it in case you're audited. Is that true?
Yeah, yep, exactly right. So it's got all the backup documentation to the numbers on that last page. The numbers on the last page are what you file, but you do need all that backup documentation to say, so if the IRS ever comes to you and says, why do you say that you've got $40,000 worth of concrete? Is that 4-inch concrete or 6-inch concrete? You've got a report that backs up that says, no, we know what type of concrete. Here's the measurements, the square footage. Here's how we valued it. It's exactly right.
Yeah. And you did allude earlier to some software that people could use to theoretically kind of get the numbers for cost segregation. My advice, and this could be the wrong advice, but is if you're listening to this and you do that, you're putting yourself more at risk in case you get the audit, because then they're going to come to you and say, well, where'd you get these figures from? And you're going to say this random website that I paid a nominal amount to or not. Instead, I feel comfortable that I have this like massive book where I could say, well, I don't know, these guys are experts. Like, cost segregation is actually in their name. I'm sure you've seen some of their reports before. This is what they're saying that we're able to put forward. And that's kind of our justification with doing what we did.
Yeah, no, you got, and the other thing with that, sorry to interrupt, but the other thing, Jason, is I found that those online do-it-yourself cost seg, they're so conservative that the extra couple $1,000s you pay to get an actual study done, you're going to get 10x that in additional return. So I mentioned earlier that we usually segregate around 30%. I've seen those do-it-yourselfs come back anywhere from 12% up to 20%. So let's say best case it comes back at 20%, and on that same building we're getting 30%. That's a difference of 10% on a $300,000 asset. That's $30,000 of additional deduction. If you're in a 30% tax bracket, that's $10,000 of additional savings. And it might cost you an extra $1,500, $2,000 to get what we call an engineering base study done. But the findings are going to be so much significantly higher that it's going to you're going to pay for it over time. So
right, your study is the engineering based one, right? Or is that another level? That's your study. And just like you went into, we can go into a couple hard numbers, not digging too much into our tax return, but it's all public record. Rory, we paid $900,000 for that property, right? That we're talking about, the one up in Guilford. Okay, the cost segregation came back, and do you remember the number that was on that back page by chance? Rory?
I don't know if
not you, Erik, but Rory knows it. Yeah, I don't expect you to know every cost seg that you've done. Rory, what was it? It had a 2 in front of it or a 3?
That was actually, I think, more than 30%. That property had a lot of landscape and betterments to the property. It had a steep driveway with a lot of switchbacks, retaining walls. So that actually increased it quite a bit. So the largest category in that particular house, even though it's a large house, was actually the exterior, the landscaping features.
Yeah. So it could have been well over $300,000 of deduction if that's the case.
Yeah, which we believe it was. And actually, as we walk through, your team had us walk outside as well. So as we're walking outside, they keep noticing stuff that I had no idea that you could actually use this in part of a cost segregation study. So like you're walking through and you're showing what some of the plants are. They're asking, what they are. You're asking about the retaining wall. And then once I heard what they were asking, I said, oh, well, if we walk down the hill a little bit further, there's a lot more of this down there. They're like, oh, there is? And I said, yeah. I'm like, so we're walking down the hill. We're showing them like, all this switchbacks and this big retaining wall and all this other, perennial plants and everything. And, I'm sure that contributed to that big number that we had, but I'm pretty sure, Rory, that the back page had a 3 on it. Let me say this though. Okay. So let's say, which we've done, we're going to pull forward all that depreciation. Rory, if we go to sell that property, we have a different basis, right?
Yep. You just reduce the basis of the property by deducted. It's the same rule as everything else. You're just deducting it faster.
So a couple things, if you're listening to this, like I'm a big proponent of cost segregation studies. I'm a big proponent of getting your money today and not in the future because of inflation and a variety of reasons, because you could leverage it to get, more assets in the future. However, keep some stuff in mind. Like, first of all, you have to pay for the asset, right? Like you go buy a new tractor, buy a new house, you got to figure out a way to pay for the house. Okay. But if you're going to depreciate, or you're going to do a cost seg to, bring the bonus depreciation for what you can take forward, your basis is lower on the house. If you sell the house, for $1 million and it's a $900,000 house, well, if we took $300,000 of bonus depreciation, our basis is now $600,000, right? So Rory, am I right that I'm now paying capital gains on $400,000 in that example, not $100,000?
Absolutely.
Yeah. So keep that in mind. Oh my God, as my voice cracks, keep that in mind.
I was just going to add to that, Jason. That's a question we get asked probably most often from tax preparers and investors is, Erik, isn't this just a timing issue? If I take all this deduction now, when I sell it in 5 years, don't I have to pay it back in the form of capital gains? The answer is yes and no. And I'll give you the no part. The reason is, I'll give you an example. I buy a property for $1 million. 5 years later, I sell it for $2 million. So when I go to settle up with the IRS, if I don't do cost segregation, I'm saying, hey, I bought this office and all the stuff in here for $1 million. I'm selling this office and all the stuff in here for $2 million. They're going to say, well, everything's doubled in value and we're going to charge you tax on that, which is somewhat true. The land is doubled in value. The walls have probably doubled in value. But where it's not true is my dirty, nasty carpet that's 5 years old has not doubled in value. Carpet, as I mentioned earlier, carpet's a 5-year asset. So what is the value? What's the book value of my carpet after owning it for 5 years? 0. Mm-hmm. I shouldn't be telling the IRS that my carpet doubled in value, and I shouldn't sell my carpet for double what I paid for it. So what we're doing is, like you said, we're shifting it. So you're taking your deduction today against your ordinary income rate. You're shifting it to a capital gains rate and saving the spread. And so, and oftentimes, even if you only hold it over one taxable year, that spread is worth doing the cost seg study. So yes, you do have to pay some of it back, but in summary, take your deduction at a high rate, pay back a portion of it, not all of it, a portion of it, depending on how long you've owned it, at a lower rate and save the spread. And that's really what we're trying to accomplish.
Mm-hmm. Rory, don't you love this free advice we get by inviting people on this podcast? Like, this is amazing. I feel like we have this like massive consulting call, and hopefully our listeners are getting a lot of benefit from this too.
Right. And I know gets into the weeds a little bit, and there are a lot of tactical information to sift through here. But if you have investment properties and you're holding them for any meaningful amount of time, and especially if one of you is a real estate professional, you need to know what we're talking about. And if you didn't get it from the first pass through, listen to this episode again, go to the Cost Segregation Authority website or find additional literature. This is something you need to know.
Yeah. And get that golden ticket if you can. Go marry a real estate professional.
Just like, Jason, I just want to add one last thing, and hopefully it's not too late to add it, but I know you guys have a lot of short-term rental listeners. One thing we should mention with cost segregation is They call it the short-term rental loophole. You guys are probably familiar with that term. I hate to call it a loophole because it's actually in the code. It's the correct way to do it. But if you have a short-term rental, one thing that you got to consider, we talked about passive income in the beginning. So like if I've got a long-term rental and I do a cost seg study, but I'm a W-2 employee, these deductions are considered passive deductions, and I cannot use them to offset my active W-2 income. So my wife and I will give you a real life example. I'm a W-2 income earner here at Cost Segregation Authority. My wife's in the school district. We have a couple rental properties. They're long-term. I can't use the deductions or the cost seg from these to offset my W-2 income. So at the end of 2022, we had a tax problem and we needed some write-offs. And so what we did is we went and bought a short-term rental. Gets treated a little bit differently than a long-term rental if, one, the average stay is less than 7 days, which usually for an Airbnb, VRBO type property, as long as your average stay is less than 7 days, and I can show that I materially participate in the management of that property. Now, the IRS has 7 tests. You only have to meet one of those 7 tests. The test that I met was we bought our property in November of 2022. I spent 100 hours at that property, and I spent more time than anybody else at that property, meaning my cleaner, maintenance folks, anybody else. Therefore, I showed material participation in 2022. When we did the cost seg study, I was able to use those deductions to offset me and my spouse's W-2 income, because that now gets treated kind of like a hotel versus a rental property. It now looks like I'm managing a hotel versus a rental property. And so that's something that you guys should be aware of. Your listeners should be aware of. There's a ton of information out there. But if you're investing in short-term rentals and you can meet that material participation, that's key. You've got to materially participate. So if the property's in Florida and I live in Salt Lake, it's going to be hard to show the IRS that I materially participate. But this property that we got was just an hour and a half north of here. We were able to show material participation, at least in 2022 when we did the cost seg study. 2023, we went and hired a management company. They manage it now. No big deal. But when I did the cost seg study and created that deduction was now considered active. And me and my spouse were able to use it to offset our active income. And, we basically on that, we saved about $60,000 in taxes, and we put $80,000 down on the property. So we got almost our whole down payment back versus I was going to pay the $60,000 either way. It was either going to go to the IRS or go down on a property, and we were able to put it down on a property. So just something to keep in mind as far as if you are a W-2 employee and you're investing in short-term rentals, definitely something to look into, because that's a great strategy to offset your W-2 income.
Eric, one of the keys right there, I literally just had that same conversation with somebody at the end of last week, for one of our endeavors, Prideway Stays, which is a short-term rental co-hosting business that serves Provincetown, Massachusetts, that one town specifically. We spoke with someone that might want to work with us, just purchased a $1.9 million property in town, really nice top property, but is a tax preparer, understands everything you literally just said right there, and wants to meet that threshold. But, here we are, we're recording this in March. It's going to come out in April, oddly enough, around tax time. One key you mentioned right there is November. So you did that at the end of that year, where the material participation, only had to go for those 2 months, and you were able to hit that number and be it more than anybody else. One thing that this person is considering is the fact that, we're at the early part of the year when we're speaking, he might want to manage himself this year and then turn it over because,
Right.
There's 10 more months in the year. So we're trying to figure out some creative ways to meet a different criteria as a result of those 7 criteria that he'd have to, or one of them that he'd have to hit. But that's a conversation that's active and ongoing right now.
Yeah, no, that was the easiest one at that point. And we were strategic about when we bought it, because if I would have bought it in January, I might have spent 100 hours there, but my cleaner or my maintenance folk might have spent more time than me, and therefore I wouldn't have qualified. And so we had to be a little bit strategic about when we bought it. We were able to get a couple renters in before the end of the year, so we showed income, we showed that it was in service. But yeah, there's definitely some strategy to it. But again, it was $60,000 that was coming out of my pocket. I'd much rather put it in an investment property than give it to the IRS. So
Right.
it worked out okay. Yeah.
Wow, this has been chock full of info. We really appreciate all of your insights and learning a lot about cost segregation and some tax strategies. We should have to disclaim this, that this is not advice from CPAs and tax preparers and attorneys. So make sure you speak with all the people that are in your life who can give their stamp of approval with those official letters after their name. But if you're not looking into this, this is a very very commonly used tax strategy for real estate investors, and it's how they're able to scale their portfolios up pretty quickly. Why don't we get to our final couple questions, Eric, that we ask of all of our guests, just to wrap things up, and then we'll learn where people can learn more about you guys. The first one, and don't say cost segregation for the answer for this one. You could, but don't. If you can get on stage for half an hour and talk about any subject in the world without any preparation, what would that be?
Oh, that's a great question. So I would actually probably talk about, one thing that I did when I went to college right out of high school, didn't know what I wanted to do. As I mentioned earlier in the introduction, I kind of just wanted to get out of college. So one thing that I always try to instill in my kids, and I think it goes for everybody, is when I went to school, I wish I would have known what I wanted to do. I just jumped into school because that's what my parents told me I had to do. I needed to get it done. I did this accounting thing. Yeah, accounting is great. Numbers came easy, but find your passion in life. And if it takes time, don't worry about taking a couple of years off. Find your passion. If you want to be, a car mechanic, be the best damn car mechanic that's out there. Open up a shop, but find your passion, because we all have to work. Unfortunately, in the world we live in, most of us have to work. And so work, if you're doing something you love and something you enjoy, it's not work, it's just something you enjoy. And so, believe it or not, I know you said not to mention cost seg. Cost seg is not my passion, I'll be honest with you, but my passion is talking to people, educating people, and helping people save money and become financially free. And so that part I really enjoy. That's why I really like this job. But that goes back, I kind of fell into this, but I would have, my kids joke, they're like, I don't know what my dad does. And it's like, well, I never went to school to be a cost seg provider, but I just kind of fell into something that I enjoy. I enjoy talking to people. I enjoy helping people. And so find what it is, your passion. And that's probably what I'd like to talk about on stage.
If we asked your parents what they thought you did, what would they say?
I don't think either of my parents know. My kids certainly don't know. I've tried to explain it to my kids. I know my parents think I'm in finance. They call me and ask me questions about the stock market. I'm like, I have no idea, Dad. I'm not going to advise you on where to invest your money. He's like, well, I thought this is what you did for a living. No, this is not what I do.
Yeah, I mean, I worked in the media business for 25 years, and half that time everyone thought I was a DJ, even though I was for just the first 6 years of that time. And then for the remaining, the back half of my career, I was a digital sales director, and try to have your parents explain what that is, and forget it. They have no idea. So, it's easy when we see Rory's parents. Your dad's always like, "How's the real estate? How's law going?" So.
Right.
He's got that. Second question, tell us something that happened early in your life or career that impacts the way that you're working today.
Oh yeah, this is an easy one for me. I mentioned that I left Salt Lake, moved to Virginia. When I left Virginia to move to New York, we kept our house in Virginia as that was my first rental property. And I blame it on my wife. I don't know how much of it was my wife versus me. My wife's very frugal, and she didn't want to pay a management company to manage our property. And so I'm like, well, I know a little bit about this. Let me give it a go. And so I, from New York, tried to manage our property. We had our first tenants in. I interviewed them. Seemed like such nice people. Didn't do a background check. Didn't do a credit check. Did it on a handshake. And they paid for the first couple months. We moved to New York. And then month 3 came, and they started getting their paychecks garnished because they had left the other place before and not paid. And so we had to try. It took us months to get them evicted. So moral of the story is, know what you're good at. I think I mentioned this before. Know what you're good at, and be humble enough to say, you know what? I'm not a property manager. I'm not a real estate agent. I'm not a marketing person. Know what you're good at, and then surround yourself with others. And so for some of us, like myself, I had to learn the hard way. I ended up losing money on that first tenant, obviously, because they weren't paying their rent for 6 months. But after that, I really realized, I can't manage these from a distance. It doesn't make sense. Just pay the 10%, find a good property management group that you trust, And so I've been able to just build a team around me of people that I trust now instead of trying to do everything myself, knowing, and being humble enough to say, hey, that marketing piece you created, Erik, looks like, a 14-year-old kid did it on Nintendo Paint. For you young generation, you guys don't even know what Nintendo Paint is.
I do. I'm older than you, Erik. I definitely know what that is.
So anyway,
maybe I don't look that way with this lighting, but I definitely, I could beat you in age. Final question. Tell us something that you're listening to or watching or reading these days.
One of the best books that I'm not actually reading it. I've read it a couple times, but I'm going to say it anyways, is Tax-Free Wealth by Tom Wheelwright. Tom Wheelwright, he's Robert Kiyosaki CPA. He's written a couple books. There's a new version out called Tax-Free Wealth, which again, it kind of walks through some of the stuff we talked about today. And again, the tax code, if you read the tax code, there's very few pages that tell you when you need to pay tax. All the other pages tell you how not to pay tax, all the deductions. And so his book really lays it out. It's a short read. It's an easy read, but it really lays out how to structure your business and how to structure your entities so that you can pay very little tax legally. And so for business folks, investors, entrepreneurs, I think it's a great book. Would definitely recommend it.
Awesome. Well, good. Well, thank you for this discussion, Erik. If people want to get a hold of you and learn more about Cost Segregation Authority, what do you recommend they do?
Yeah, best way to get a hold of us is through our website. It's just www.costsegauthority.com. My contact information's on there, my cell phone, my email. Please use this as a resource, you guys. We love to educate. We're kind of unique. We don't bill by the hour. Please don't call me and ask me about child tax credits or earned business income because I don't know anything about that stuff. We don't do tax returns here at our firm, but if you've got real estate tax questions, we're happy to help. We've got a wealth of knowledge upstairs with all of our CPAs, and if we can't find the answer, we've got resources to be able to get you the answer. So we'd love to help you any way we can.
Awesome. And, this is 100% not a paid episode. There's no paid endorsement here. We would love to get commission fees from advertisers, but we're not doing that with these guys. We are clients of theirs. We really appreciated the work that they did for us and the tax savings that we had, the education that we got from the other conversations we've had. I loved hearing Erik speak on stage at Bigger Pockets. When we reached out to your company, the amount of time they took to walk us through the process, it was legitimately one phone call to make. Like there was no shopping around. It was, how much do you want to charge? That seems fine. Let's go do the study. So that was our experience with working with your company.
That's great to hear.
Rory, where can people get a hold of you?
If you just go to rorygill.com, RORYGILL.com, you'll see all the different ways you can get in touch with me and the different ways I can help you out.
And if you've enjoyed this episode, we love 5-star reviews, 5 stars. We read all your comments, so please comment away on YouTube or on wherever you heard or saw this episode. Please subscribe and tell your friends about the Real Estate Law Podcast. And if you want to be a guest, you can go to realestatelaw.podcast.com. You can see all of our past episodes, and you can fill out the form and let us know who you are and why you want to come on, and we'll get you going. Hey, Erik, thank you so much for all the time today. This has been a pleasure to get to know you a little bit more. And you are literally the second person in a row who we've recorded with, who I saw on stage at a conference, randomly was in the same room with them. And now here we are doing an episode. So
hey, it was a pleasure. Thanks for having me.
We appreciate that. And thank you for listening, and we'll see you next time.